From the very beginning, Bitcoin has sparked debates, technical, economic, and even political. Some of these are relevant to other digital payment systems too, but Bitcoin's risks are often misunderstood, both in nature and scale. Today, I want to break down the potential risks linked to the Bitcoin network, especially for finance professionals like you. First off, Bitcoin, like most cryptocurrencies, has no underlying assets or collateral. When you buy Bitcoin, you're simply paying the seller. Its value is driven entirely by ongoing demand from buyers. So at first glance, some might say this resembles a pyramid scheme more than a monetary system. But if you followed my previous discussions, you know the story's more complex. Storing Bitcoin actually helps secure the network and contribute to its resilience. Still, it's crucial to understand the risks. Let's start with volatility. Bitcoin's price is famously volatile. With a capped supply and growing demand, price swings can be dramatic, often triggered by news events, regulations, or market sentiment. Like any floating currency, its value fluctuates differently against various fiat currencies, sometimes wildly so. Next, irreversibility. Once you send a Bitcoin transaction, it's final. There's no chargeback. If you mistype an address, those coins are gone for good. This feature boosts security, but means there's zero room for error. Then there's the internet dependency. Bitcoin relies entirely on the internet. In the event of a massive internet outage, think large-scale power failure, government-mandated ISP shutdown, or even censorship, Bitcoin transactions could slow to a crawl or stop altogether. Technical limitations are another talking point. Bitcoin's database, or blockchain, is growing rapidly, demanding more and more hard drive space. Some experts worry about this trend, but with advances in storage and proposals like pruning old transactions, there are ways forward. There's also the block size debate. As the network grows, propagating new data can strain regular nodes. Some have suggested supernodes or simply relying on Moore's law to keep up. Institutional risk is real too. To swap crypto for fiat, you usually go through an exchange, which are private businesses. History has shown these can fail, as with the infamous Mt. Gox collapse. That said, peer-to-peer trades or bartering for goods and services can sidestep this risk but aren't always practical. Now, the environmental impact. Mining Bitcoin uses a lot of electricity, anywhere from 0.15% to 0.32% of global power consumption, depending on who you ask. When powered by renewables, the impact is lower, but in places reliant on fossil fuels, it can be significant. Many mining farms have moved to cold climate countries with cheap hydro or geothermal power, but the real energy mix varies seasonally and regionally. There are also ethical concerns. Early adopters own a large share of Bitcoin, making wealth distribution highly uneven. Critics sometimes call Bitcoin a Ponzi scheme, but the comparison doesn't really hold. There's no promise of payouts funded by new investors. The price is simply a balance of buyers and sellers. Finally, regulatory and legal risks. Some central banks have issued warnings about Bitcoin's speculative nature, legal ambiguities, and potential for misuse. Others, like the US and Germany, have taken a more open-minded stance. The regulatory landscape remains a moving target, so staying informed is crucial. Bitcoin continues to evolve, along with its risks and opportunities. As finance professionals, understanding these nuances is key to making informed decisions in an ever-changing landscape.